No, we go to executive session and then we'll ask you. Don't worry. We'll make it perfectly clear to you. Yes.
I think that there is they moved this calendar to the
it's on.
just so that any
All right.
outstanding checks.
Good morning, everyone. We have a large agenda. We'll call the meeting to order. The first order of business is to call the roll. Controller,
Michelle Markadine.
Mayor's
representing
office.
Controller Scott M. Sterner.
Mayor,
John Grathwall, Mayor's representative.
Public Advocate,
Good morning, Mr. Chairman. Umair Khan here on behalf of the Public Advocate.
private member,
Michael Spitzer.
other private member,
Bud Larson.
and Bernard Rosen, the chairman. Good morning. Oh, here's the other private member. Let's wait a minute. Mr. Kaplan. They took a train out of service, so it's a disaster on the subway. Don't run, don't run, don't run. We can't run. First order of business will be the approval of the minutes of the meeting of May 18th. Do I have a motion?
Could I make one suggestion?
Yeah.
Shouldn't we list everybody who was there at the meeting, at least from the committee and maybe other people? Because that's what.
I thought they did. I thought they did, Mark. Honestly, I thought they did.
Didn't have it.
Yeah,
No, there's another one. All right. Fine.
yeah. They did. By the way, they're a very good set of minutes, so I'd like to hear a motion for approval.
Motion.
So moved.
Second.
Hearing no objections, we'll go right to the Health and Hospital.
I have one question. What about the New York Public Library?
The New York Public Library was subject to the same analysis.
Mike, let's put it into context. Context is when there was some trouble at the Queens Public Library, the public advocate made a suggestion that they ought to investigate it, so on and so forth. The controller did an audit. Bottom line is, now the CAFA for the city will include the Queens Public Library and the Brooklyn Public Library. So Michael Spitzer is asking, what about New York Public Library? Go ahead.
So the New York Public Library, which we conducted what we call a GASB 14 analysis of, which is looking to see if under the guidance of the Governmental Accounting Standards Board, an entity should be part of the reporting entity of a primary government. Because of the control structure, the boards of directors of the Brooklyn Public Library, we do not need to include them in our CAFR, and we do not have the same oversight responsibilities as we do for other entities as a result.
The financial aspects?
Thank you.
I'm sorry.
Besides the open governance, what about the financial?
There is not a financial benefit and burden relationship that would require.
Okay, thank you.
Did everybody hear the response? Good. The first order of business, also before we go to that, I need a vote from the committee to go into executive session after the regular session. Have a motion?
Why don't we do that at the time?
We'll do it at later.
Okay, it's done. No, it's done.
Oh, I see. That's a mistake I made. I didn't read this page, but I read that page.
Yeah. You ready with the HHC?
Sure.
Okay. The first order of business is the New York City Health and Hospitals Corporation statements. I'm a member of the board, so I have to recuse myself. I'll turn it over to Mr. Kaplan, and would you be just good enough to introduce yourselves?
Sure. So my name is P.V. Anantram. I'm the Chief Financial Officer for New York City Health and Hospitals. On my left is James Linhart, who's the Deputy Controller for the corporation. I've got my financial audit partners from KPMG, Maria Tizo and James Martel. And behind me is our team from the Controller's Office, Liz Guzman, Marshall Bondi, and Joseph. Joseph, last name always escapes me. Dubroya.
Found it?
Thank you so much. So we're here to talk about our 2015 financial statements. As you all know, the health and hospital system is a system of 11 hospitals, 6 DNTCs, 70 odd community clinics, 5 nursing homes, and our primary mission is to serve those who can ill afford health care. As such, most of our revenues, over 90% of our revenues, come from government sources, and about 30% of those revenues are supplemental payments to accommodate the fact that we serve the predominantly poor population. And as you also know, over the last many years, the healthcare has been going through a lot of transformation. Almost every year there is a new revision to the previous year's reimbursement mechanisms with new models of healthcare coming out. And 15 similarly was impacted by some of those changes, and as will be 16 and 17 in the future. I will touch on some of the major things that impacted 15, and I will hand over to James here on my left, who will walk through the financial statements. One of the big things that, as I mentioned in my opening statement, impacts our financial statements are supplemental payments that we get from the federal government, 30%, which is about $2 billion in size, approximately, which is on the decline, but it's about $2 billion. And in 15, we received a substantial amount of money that was due to us from prior years, close to $1 billion. So 900 of it was attached to prior years that allowed us to bring prior receivables down significantly. A second piece of item that also happened was the implementation of DSRIP. The state government received a waiver from the feds to the tune of $8 billion that was primarily driven at trying to figure out how to reduce avoidable admissions in hospitals by 25% over the next 5 years. Significant, and it's a payment over a 5-year period of time. The health and hospital system received about $1.2 billion of that. That's a maximum that is potential earnable, and it is the first couple of years are payments for metrics in terms of getting prepared for delivering a proposed outcome, which is a reduction in avoidable admissions. The last few years are based on performance metrics. In 15, in fiscal year 15, we received about $111 million from that particular transaction. A last piece that was a deviation from prior years was in alignment with the city's books. We moved from current liabilities to long-term liabilities, our payments owed to the city for fiscal year 15. And that was, do you have the number? Well, James will run through the details on it and will tell you how much that was.
Sure. Good morning. First and foremost, we were issued a memorandum with Directive 22 from the city advising us of early adoption of GASB pronouncements. So just to let you know, we did adopt GASB 72, which is Fair Value Measurement and Application. If KPMG will go into the details on that if required to do so. But moving forward, our current ratio for 2015 was 0.84 as compared to 0.87 in 2014. Net days cash on hand, 35.01 as compared to 19.5 on 2014. Net days revenue patient receivables, 61.19 in 2015. 71.91 in 2014. Just to give you some averages, we requested some information from the Greater New York Hospital Association, and we had received 2013 figures, which is the last year that they have, the earliest they have available. It's from their institutional cost reports. New York City average current ratio is 1.25. Days cash on hand is 40.84, and net days revenue and patient receivables is 71.7. Just want to give those as benchmarks for the city. The New York City Health and Hospitals ended fiscal year 2015 with a decrease in net position of $76 million. The net deficit position at the beginning of the year was $5.109 billion and $5.186 billion at the end of the year. The major changes in the statement of net position are as follows. During fiscal year 2015, New York City Health and Hospitals, as PBI alluded to, received $599 million for 2 years' worth of retroactive inpatient upper payment limit funds. This event led to a $268 million increase in cash and cash equivalents from $343.2 million in 2014 to $611 million in 2015. Additionally, this receipt of UPL funds contributed to a $540 million decrease in estimated third-party payer settlements receivable. The estimated third-party receivable of $890 million at the end of the year primarily consisted of the current year's receivables. Approximately $230 million of outpatient UPL is still due from the state for fiscal years 2012 to 2014. DSRIP, Delivery System Reform Incentive Payments. In June of 2015, New York City Health and Hospitals received a net DSRIP payment of $111.1 million from New York State Department of Health. This transaction was recorded as grant revenue for the fiscal year ending June 30th. Due to, from City of New York, increased $332 million from 2014 to 2015, primarily due to an increase in debt service of $153 million in 2014 to $301 million in 2015. Furthermore, malpractice payables increased from $126 million in 2014 to $250 million in 2015. The 2014 due to City New York payables were extraordinarily low due to the impact of the city's forgiveness of the 2013 debt service of $121.5 million and malpractice of $150.4 million, which took place in 2014. As PV had alluded to earlier, the 2015 portion of the due to City of New York was reclassified to long-term disabilities. That's those are due over 1 year, and 2014 portion remained in the short term. This reclassification resulted in a positive effect on our current ratio. There was a $74 million decrease in capital assets net due to the ongoing major modernization projects across the healthcare system, which were mostly completed during fiscal year 2014. It is expected that the future capital assets amounts will increase over the next few years as New York City Health and Hospitals signed a $1.72 billion Public Assistance Alternative Procedures Program letter of undertaking with FEMA, the State of New York, and the City of New York in 2015. This agreement secures the necessary funding to not only restore damages from Superstorm Sandy at Bellevue, Metropolitan, Coney Island, and Kohler hospitals, but also increases each facility's resiliency for future storms. The pension liability increased by $298 million. The current portion of pension that is due within 1 year increased $9 million, as the corporation's annual pension contribution increased by the same amount. The remaining increase of $289 million is attributable to the corporation's recognition of its annual pension liability, as determined by the New York City Office of the Actuary. Should be worth noting the total pension liability, which is the current and the non-current portion on 2015 financials, is $2.768 billion. Post-employment benefits obligation, other than pension, or otherwise we all know as OPEB, decreased $148 million due to a change in actuarial valuations, and we rely on the city for those numbers, the city actuary's office for those numbers. Moving over to the income statement. Our operating loss decreased by $35 million, $58 million in 2015, as compared to $93 million in 2014. The operating revenue increased $69 million, primarily due to a negligible gain in patient service revenue of $76 million, an increase in grants revenue of $241 million, primarily related to the recognition of $137 million in interim access assurance funds payments, and $117 million of DSRIP. Decrease of, and also it coincided with a decrease of appropriations revenue of $259 million, mainly due to the city and health and hospitals agreeing that the 2014 debt service and malpractice payments for 2013, which, as I said, were $150 million and $122 million respectively, would not be paid. It should be noted that the 2014 debt service and malpractice payments as listed as due to the city as of June 30th, 2015. Operating expenses increased by $34 million, with personal services increasing by $68 million, basically due to collective bargaining settlements and a slight increase in FTEs of 795. An increase in OTPS other than personal services of $34 million, mainly attributable to the increase in pharmaceuticals expense of $28 million and IT software maintenance expenditures of $17 million. Our fringe benefits and employer payroll taxes increased $50 million due to a health benefits increase of $27 million and an increase in welfare benefits of $17 million. Pension increased $61 million, and this is determined by the New York City Actuary Office. Affiliation contracted services increased $72 million due to market adjustments and enhancement services. And then our OPEB, our post-employment benefits, decreased $239 million, and this was as determined by the New York City Office of the Actuary. And it is predicated on assumptions for healthcare actuarial gain experience, cost trends, updated to reflect recent past experience and future experience. And we also had a depreciation, a decrease of $11 million, partially due to the recording of a loss on retirement due to the closing of the Goldwater campus, which we moved up to the Carter campus in Harlem. Other changes in net assets decreased $207 million, mainly due to a decrease of $197 million in capital contributions funded by the City of New York due to fewer continuing major modernization projects. With that, that's my report for the synopsis of the financial statements.
Anything else you'd like to tell us before we turn to the committee for questions?
No.
Sure. We're open to questions anytime here.
Okay.
I think this sort of concludes our presentation here. I don't know whether you want to add anything.
Yeah, I can. So again, my name is Maria Tiso. I'm the lead audit partner. Just a few points. We met with the audit committee of the corporation on October 8th. 2015 to go through our required communications. We issued our opinion on October 15th, which was an unqualified opinion, which is the highest level of assurance that the financial statements are free of material misstatement. In order to render that opinion, we did review the internal controls over financial reporting, not to give an opinion on internal controls, but it's part of our audit process to render the opinion. We noted no material weaknesses or significant deficiencies in the internal controls over financial reporting. Again, as James had mentioned, there was one new GASB statement that was adopted relating to fair value disclosures. Again, there was no impact to the balance sheet or income statement. It was just enhancement to the footnote disclosures. Again, we had no difficulties in performing the audit. We received full cooperation from management. We also did issue a management letter. The management letter is broken out into 3 parts. The back part talks about industry comments that we've been including in a lot of our healthcare systems relating to just issues going on in the healthcare industry. And then we have one section that talks about facility comments, again, best practices, things that management is currently working on. And then we have other comments where there were prior year findings that have been remediated by management. So that concludes just some of the observations that I wanted to point out.
Okay, it's interesting. Your industry comments thicken the.
They get bigger and bigger each year.
You get paid by the inch.
The healthcare environment is very challenging.
I know. Let me start off with one question, and then I'll turn around to everybody here. When you give the numbers and you say that, as you did the percentages comparison, do you have internal targets of what you'd like those various statistics to come out? Do you measure against current all those percentages that you've gotten by comparing yourself to other hospitals in the city? Do you have some management targets of your own?
I presume you're referring to the current ratios and days of cash on hand.
All that, how you measure how well you're doing.
There aren't strict metrics on that. it's always nice to have more days of cash on hand than otherwise, but a decent target would be in the $200 to $300 million range in terms of having cash on hand. We will, as we are currently forecasted for fiscal year 16, hope to end the year with about $120 million in cash in hand. Last year we closed with about $530 million of cash in hand.
So you don't have any targets to which you hold your managers accountable?
Not particularly.
Okay. Gentlemen, anybody? I turn to the right. I'm not a Republican, but I turn to the right. Go ahead.
Mr. Chairman, I do have a number of questions, actually.
So do I, but I'll wait.
So on page 12 of the audit, you've mentioned $71.5 million in market adjustments and enhancement of services. And it's about an 8% increase. Could you explain what that increase was?
You're talking about the affiliation contracted services?
Yes.
So we have affiliation contracts for all our hospitals to the tune of over $1 billion. So, and a lot of this, I can't give you the exact details on it, but in the scheme of things, it's not a large change, but we constantly negotiate additional needs based on hospital requirements across the system. So we can get back to you to exactly what this detail is, but I presume it is just normal activity, business activity.
Okay. Also, there's it's mentioned in the auditor's letter as well, with regards to the Epic EMR system and its implementation, and some of the challenges that there are with that. What progress are you making in addressing those shortcomings, and why is it going to take so long to implement Epic?
So the Epic system is an implementation over the next 3 years, 2 to 3 years, about valued at about $760 odd million for the next 5 years phase of it. And we, as is normal for any large system implementation, there's always going to be hiccups in the process. We initiated the first go live in Queens and Elmhurst hospitals April 1. Went without a hitch. I shouldn't say that. Went with a few hitches, not of any major magnitude. The level of requests for corrections in the system have continued to trend downwards. Our next install is getting ready for in Jacoby. In terms of large installs, what we've heard is that we've gone off better than most other systems implemented, or similar systems implemented in other large environments. So we are pleased that everything went well, and we hope that that will be the trend going forward.
Please, go ahead. Oh, I thought you wanted to say something.
You want to say something?
Oh, no, I just wanted to let you know that December 3rd is our target date for implementation at Jacoby NCB campus. And we should be fully implemented. Our target date for full implementation across the entire spectrum is December of 2018.
I'm sitting on
My
top
colleague, my colleague was kind enough to let me ask a follow-up question on this topic before he went on with his questions. I noticed in the comments from KPMG that one of their concerns was a lack of oversight of the contractors. That is a significant concern citywide. In fact, the controller issued Directive 31 at the beginning of his term in order to address controls over contractors, especially in the IT area. Can you comment on what changes you've made or are making?
As I recall, the comment was about appropriate classification of consultant times and recording of those hours in the use in marking the expenditures towards the EPIC project. EITS, which is our acronym for IT systems in the health and hospital system, has created a separate scorecard of all of the hours worked in the particular project, and has created the system to measure those consistently. So.
And when was that put in place?
That's been put in place sometime this past year. between the time that KPMG actually issued the management letter and today's date. I forget what the exact date is, but I have written down that EITS has implemented an automated timesheet tool which requires consultants to enter time workload as well as maintain activity log of each of the tasks performed.
Thank you.
That's endemic of every one I've ever seen, but what I found, it's not disappointing, a little bothersome, is that it hadn't been done before KPMG got on your case. I mean, these things should happen going into these systems and plans, because there's a lot of loose stuff there unless you tighten that up.
We've actually also incorporated a worksheet or a tabulation key that we use on the timesheets for staff who are employees of the health and hospitals, whereas so we could capitalize their payroll services for the EPIC project as well. So those personnel who are working on the EPIC project, who are employees of New York City Health and Hospitals, they'll use a separate code on their timesheets, and we'll capture that code when at year end, and then we'll reclassify their salary expense and their fringe benefit expense into capital related cost. So then we would be able to receive depreciation expense in the form of the depreciation expense we'll get as reimbursement in our Medicaid rates, or a portion of it. So it's a benefit for us.
I don't mean to be cynical, but let me pick this up another level, and that is who's checking on whether those timesheets are an accurate statement by the employees or the consultants?
Well, we have a process that where they sign it on the timesheet for the employees. They sign it on a timesheet, then they also submit a log as well. And we use the SharePoint website where they submit the logs, and the supervisors have to sign off on their time period.
Okay.
The HHC supervisors?
That's
your
correct.
internal staff or the consultants, managers?
No, the HHC supervisors.
Thank you.
So Michelle actually got to the point that I was going to ask, so great minds think alike. So the point was is that you guys expected to implement this by December 2015. So I just wanted to make sure that
18.
No,
Jacoby.
the issue with regards to the EITS in the auditor's letter in your management response is that the target date for full implementation is December 2015. So I just want to make. I mean, if you're in and around that time period, the EITS, right?
Right.
Yeah. It's on page 4 of the letter.
I guess the management's response said it was going to happen
Yes.
by December 2015.
Yeah. The question, it's after the date.
It's after the date.
So the question is whether it's done.
Correct.
Yes.
Yeah, to clarify, it's
Yes.
done. Okay. The next question, I was trying to be a little diplomatic.
I'm sorry. I marked mine in red.
No, thank you for pointing that out, because I actually wasn't aware. I'm not that I wasn't aware, but I didn't remember when they put it in place.
That's fine.
Thank you.
Next question is with regards to the affiliation contracts. So there appear to be a number of recalculations that have had to be made. How are you making progress on addressing the need for making recalculations, and what's the magnitude of those recalculations?
The last recalculation I saw was in the $100 million range. But a lot of that, and we are a lot more on top of that than we had been in the year that was cited. And a lot of the reasoning for that was the utilization levels have actually gone up in the contract, so there's a lot more urgency for the other party to request updates. So not only by due of the fact that we are a lot more diligent, but there's also an increased demand on the other side to be up to date on that matter. So but it's still $100 million as a correcting factor. That it's in my opinion still a large number, but I think we'll get there better as we go along.
Okay.
The needs in the hospitals in terms of utilization factors continue to change all the time. So,
But you're adopting protocols.
yes, we have a person devoted solely to the affiliate contracts in terms of the calculation of their spend and budget allocations, and we are requiring them to submit information on a more regular basis. Part of the reasoning for the true-up was the fact that we didn't always get the information on time from our contractors, from our affiliates, and now because they are running short on cash, they are up to date on it.
They're expediting their
Yes.
price. Okay. The next question is, it's not mentioned directly in here, though there is a section on information technology. The U.S. Attorney and other people had a recent conference at NYU Law School on network and data security, especially at our healthcare institutions, and how they're ripe for theft, and not just by employees but by hackers. And this could be to the auditor. In your estimation, is HHC up to pace when it comes to network security and ensuring the records and their data?
I can start. That's a hard question to answer. I mean, just from our knowledge in the healthcare industry, they always say every health system it's not when it's going to happen, not how it's going to happen, when it's going to happen. So I don't think there's any system out there that is 100%, foolproof against a cybersecurity attack. I think there's a lot of improvements that every health system, including HHC, that can do going forward. Again, if you look at the risks of every healthcare system, cybersecurity is on the top of every healthcare system's list. So I don't think there's any organization out there that's 100% foolproof that they won't be hacked.
Right. But there's a gold standard, and so I was just curious as to whether or not HHC is implementing that gold standard when it comes to protecting. I mean, nothing's foolproof, but there could be something that is the best metrics that are there, the best practices.
I think more work could be done on cybersecurity.
In the public company context,
Yeah.
the board designates a committee that's responsible at the board level for oversight of that. Do you have such a board level committee?
We do have a committee for information technology, and so, I mean,
You were the
we can
secretary?
definitely get back to you on our.
Oh, good. Well, that's the practice in the for-profit world. Can I now? Anybody else on the line want to ask questions? I would like a couple. I don't understand. That's my lack of accounting capability. Page 3. There's current liabilities and other non-current liabilities. So you draw a distinction between the first number and the second number, other non-current. What's the distinction between those two lines? No, it's page 3. Page 3. That's the number. But I wonder what makes one other and one current, and why you drew the difference.
Okay. So are you asking the difference between current liabilities and non-current liabilities?
No, you have two lines. One says current liabilities, the other one says other non-current liabilities. So I'm trying to understand.
So current liabilities are any liabilities
Right.
that are expected to be paid within the next year,
12 months.
within the next 12 months. Other non-current liabilities are expected to be paid in the future.
So those are long.
Those are
more than
long-term,
a
right?
year.
So
Okay.
this schedule doesn't break out between current and long-term. Okay. But
Okay.
I believe if you go to the
It's back-
actual
it's in the
balance
back.
sheet, it's broken out
Yeah.
that way, yeah.
Okay.
This is the MD&A disclosure. There's a required format that's... Yeah.
I have one more question here. You have the OPEB other than the net current portion. As I understand it, it's a pay-as-you-go business for OPEB, and there's nothing that goes in there. So is this an appropriate way to describe it? I guess it is if you certify to it.
I guess I can start. So any OPEB obligations are done by the City of New York's actuary. So there, Michelle, I don't know if you want to further explain that.
No, I understand that.
Yeah.
I'm only asking the nomenclature here.
HHC, unlike the city, does not use governmental fund accounting. They're on full accrual.
Okay.
So they recognize an expense based on the incurred OPEB costs.
I got it. Bear with me, folks. I give you someplace in here. You'll have to fix up some little stuff, and I'll give that to somebody. I don't want to take anybody. The other element is for those of us who are nearsighted that those pages are very small print. Now, then we turn to page 22. There's a reference in the third bullet to debt on corporate assets, corporation assets. I can understand. Is that secured debt? Is that why you call it debt on corporation assets? Or is it just debt?
Where is it?
Here. What is meant by debt on corporation assets? Is this thing was just plain debt?
Are you on the
The
I'm
last
sorry.
bullet, the last bullet of page,
It's page 22,
Yep, which
the
bullet?
third bullet. Indications,
Second line.
and then it says interest on State Housing Authority agency, debt on corporation assets. I don't understand what you're driving at. Is it secured debt?
Mr. Kaplan, it's an allocation of the city general obligation bonds that were used to purchase assets that are reported as assets of the corporation. So it is not that the debt is specifically secured by the assets, it's that it's city general obligation debt, which was issued for the purposes of acquiring
Then I don't think
their
this,
assets.
I don't think this language is the language you should use, because it's confusing. And then
We can work with you on clarifying that.
It's there.
oh, there's some minor stuff here about language. I'm not going to bother you. You can pick it up. All right. If there, I think the rest I have are so small that I'll just give you the book.
Right.
You've had that before from me. So, is there anything else from anybody on the committee?
Yes, I just have a couple more, if that's
Please,
okay.
Michelle.
The first thing is, I thought that the statistics that you gentlemen quoted with regard to days cash on hand and current ratios, I think that that was very useful. I didn't notice it in your MD&A. I'm not sure it was in there. It would be great to see that. Or if it's something that you calculate just for this discussion, maybe you could hand that out to us at the time of the meeting. Thank you. I've been corrected.
It's on page 5 of the MD&A.
Terrific.
Bottom.
Thank you. And with regard to the MD&A, at some points you quote both dollar amounts and percentages, and at some places only one or the other. It would be great if you would do it consistently with both, because it really helps put the numbers and the changes in context.
Okay. Anything else?
Just one last question, Mr. Kaplan.
Please.
So looking at your expected debt going forward, I just had a question with regards to as HHC is seeking to transform into more ambulatory care, how are you going to do that without more capital infrastructure and issuing bonds to do that?
The city has, in the executive budget, allocated $100 million over 4 years. And besides that, in addition to that, rather, there is a further allocation for the new clinic out in Staten Island. What's the name of that place? That has been under construction for quite some time. So there is a significant amount of allocation available for us to do that transformation to ambulatory care.
So you don't anticipate issuing bonds or issuing debt in order to?
At this point in time, we don't see the need to do that. The city
Okay.
has made that allocation available for us.
Thank you.
Other way of doing it, right? I tell you, looking at my notes on the cybersecurity thing, you can't use your own auditors to consult on whether you have up-to-date, state-of-the-art stuff. Do you get some consultants in this area to help you?
So I'm not well informed to answer that question. I understand and I agree that it is appropriate to have somebody else other than ourselves test to see whether we are up to snuff. But I can definitely get back to you on what our current procedures and protocols are regarding that.
I don't sit on a committee of the size, enterprise of the size of this in another sector, but I've seen what it can do to once you get hit. And if you haven't had that done in the private sector, you get sued promptly for lack of supervision.
Mr. Kaplan, two comments. One, there are many consultants out there who will do a risk assessment for the corporation in terms of cybersecurity, IT control, IT security. And yeah, the auditors can do it, but a lot of corporations do maintain that line. Secondly, as it relates to when and if you do get hit in the private sector, one of my major health systems did get hit, and 11 hospital system in Baltimore, Maryland, and they were shut down for IT purposes for almost 2 weeks. They were doing everything by paper. And just think about what that would do to the corporation.
It's no fun, even in a small enterprise.
And I lived through a nightmare for 2 weeks trying to help them get back on board. So if not, one of the suggestions would be a risk assessment associated with cybersecurity on the IT systems should be had.
Yeah, okay, well, I don't know how the rest of the committee feels. It's certainly something I would urge.
We can have that. Why don't you step up? Liz Guzman has something to add.
I happened to be in the audience the last IT committee last month, because we were presenting on a resolution for approval, and someone did present from our IT department, a senior person, along with this chief information officer, a very detailed analysis of where we are in terms of protecting against cyber attacks. And they also showed goals as well as where we are and how far away we are from meeting those goals. One example that I do recall is things like a lot of the spam email that goes out. They recorded something very large, like possibly 2 million emails that are protected and just taken away from people's accounts before it turns into potentially a virus and so on. So there is activity. There's certainly room for improvement, but there's definitely activity that is taking place aggressively to monitor this, and it's reported to the board.
Good. Good luck. Anything else here from the committee? Thank you all very much as usual.
Thank you very much.
You're lucky to have a member of the
Indeed. Indeed.
It's a complicated agency, believe me. They're a good group of people.
Okay. Back to you, Bernie.
All right. I gather
Thank you.
Next order of business is the New York City Housing Authority, and you will...
I will recuse myself because I'm a member of the audit committee.
Okay.
Taking turns.
Hey, wait, you guys want this stuff?
Yeah, sure. I'll take it.
Let them come around. Don't throw it.
It's too far to throw. I think somebody's crippled.
No. They're good. They're butch good.
You ready? Okay, there you go. If you have any questions about my handwriting, give me advice. You know, the presentation that guy made with all the statistics would be well if we had that in writing beforehand. When he read off a whole list of things, he presented it. I don't... Exactly, that's what it was. I wasn't sure. Yeah. Sure. Yes, it is. I've gone over this with them. So I have nothing to say because I said it all. God, I'm still drenched.
Thank you all for your patience. We had HHC. It took a little time. Just quickly introduce yourselves. It's hard to remember. You were the Chief Financial Officer.
I am. Good morning, everyone. I'm Karen Caldwell, Chief Financial Officer of the New York City Housing Authority. I have with me today Jeff Pagelson, who's our controller, and Danny Freiberg, who runs our general ledger. Tricia Roberts, who's head of our internal audit, Teresa Puccio, our treasurer, Brian Clark, Senior Vice President of Operations, and Bob Morano, our Chief Investment Officer.
Thank you very much. And Deloitte, you're the auditors of record, okay. Do you have a statement there, or?
I do.
Go ahead.
I do. Just a moment. So first, as you know, the authority was created in 1934. It's a public benefit corporation chartered under the New York State Public Housing Law, and the authority is a component unit of the City of New York. The authority provides affordable housing to approximately 400,000 low-income and moderate-income New York City residents in 328 housing developments with approximately 178,000 apartments in the 5 boroughs. Through the Section 8 Housing Choice Voucher Program, the authority assists approximately 87,000 families in locating and renting housing in privately owned buildings. Additionally, the authority oversees a network of over 400 community-based facilities that include community and senior centers, healthcare terminals, daycare centers, and Head Start and educational centers. The authority's basic financial statements consist of a single enterprise fund, which includes the following programs: Low Rent Housing Program, Public Housing Capital Fund Program, Section 8 Housing Choice Voucher Program, and Section 8 Rental New Construction Program, and other grant programs. So we're pleased to present the financial statements of NYCHA, and all of the basic financial statements are prepared on the accrual basis of accounting and contain management discussion and analysis. Basic financial statement consists of statements of net position, statements of revenue, expenses, and changes in net position, statement of cash flows, notes to the financial statements, and required supplementary information. So turning to the financial highlights for 2015, the authority's gain before capital contributions for 2015 was $39 million, compared to a loss of $318 million for 2014. One of the leading factors contributing to this $357 million favorable result was the continued support from the City of New York in the form of subsidies and grants in the amount of $150 million, and the forgiveness of certain payments in lieu of taxes, which the city has agreed to waive for 10 consecutive city fiscal years through city fiscal year 2025. Another favorable impact was a decrease in other post-employment benefits of $116 million due to an actuarial gain resulting from lower than expected premium increases for Medicare Part B, welfare fund contributions, and health insurance. Excluding the impact of OPEB, the authority's loss before capital contributions decreased by $241 million, primarily due to increases in non-operating revenues and tenant revenue, plus a decrease in operating expenses. Tenant revenue increased by $34 million, due primarily to an increase in the average rent per unit, including households required to pay 30% of family income towards rent. Non-operating revenues increased by $90 million. Subsidies and grants made up $79 million of this increase, primarily representing city subsidies and grants for special initiatives. Gain on the sale of capital assets increased $12 million, primarily representing the current year gain recognized on the sale of Section 8 new construction, referred to as the Section 8 recap, developments, and this happened in December of 2014. Since the revenue from this transition is being recognized over the 15-year period, low-income housing tax credit compliance period. Operating expenses, excluding OPEB, decreased by $121 million. General and administrative decreased $27 million, primarily comprised of $55 million due to forgiveness of the payment in lieu of taxes by the city, and $23 million in general liability and workman's comp insurance, partially offset by an increase of $49 million in employee benefits, which includes the effects of actuarially determined pension plan investment portfolio performance. Maintenance and operations decreased by $31 million, primarily represents decreases of $33 million in pollution remediation costs and for the removal of for the removal of asbestos and lead-based paint and the absence of $16 million in 2014 reductions in inventory related to an inventory liquidation program. This was partially offset by an increase of $34 million in labor costs due to the collective bargaining settlements. Utilities decreased $20 million due primarily to lower heating costs due to the conversion from fuel oil to heating gas from the boilers at locations which were affected by Superstorm Sandy, and to lower electricity rates. Rent for leased dwellings decreased $19 million due to a reduction in the number of units in the Section 8 Housing Assistance Program. And with that, I will open it up to any questions that you have.
Thank you. I just have a few. A negative expense is a revenue? I'm teasing you. You had to show it because you had the expense the year before. That was a big change. That helped a lot, at least on the statement, though it's a non-cash item. How much was the rent increase in March, on average?
With the flat rents, tenants are expected to pay 30% of their rent, the increased to over time. They're going to increase to 80% of fair market rent,
rather than a specific rent increase.
Well, overall, NYCHA's rent increase amounted to about $20 per unit over 2015
as an
compared to
average,
14, on average
per month.
So the 30% increases were higher than that, but some tenants went lower because of change in residents and the way they report their income. So you run the entire Section 8 program, or this HPD runs one too?
We have our own separate Section 8 program.
So there may be some other Section 8 programs in the city?
Yes.
I see.
Correct. There are. I'm sorry to interrupt. There are other Section 8, and it is through HPD. You're correct.
No, but this is an important one. How is that working out? Of course, there's always been criticisms on management letters or single audits on the Section 8 program.
There was nothing.
No problems at all. All right, good. No, that's good, and it helps a lot of people stay in affordable housing. We had HDC appear before the committee last month. They were very helpful to the housing authority issuing debt, which is good. I mean, you need these things. I had another question. And your protective services are the housing police?
They're generally security, contracted security guards, plus not the housing police.
Police, because they're now part of the city police.
Correct.
Right, okay. But they're stationed at your projects too, are they not? The housing police? Yes.
Technically stationed, not sure. I know we have a very close association with the PSAs. So we have a very close association with the police department.
Just so everybody knows, I've had my fun with this one at an audit committee meeting there.
But
the one thing I'd like to suggest, Bernie, is that if they would talk just briefly, some general, how many people you actually house, and if it was a separate city, where would it rank in the United States? Do you know?
That's interesting.
I think it's 600,000 in total, so I don't know where we rank.
But you have about 400,000 residents?
I think
go ahead.
I think we have about 400,000 residents. We have another 200,000 Section 8, where I think we compare to the size of Boston. I think it's where we kind of look at it.
So 600,000 people.
It's a big operation.
That's what struck me.
Naturally, I talk to Mr. Kaplan sometimes, not only on the committee or separately. Since he's been on your audit committee, maybe it's an unfair question. He says one of the major problems in the housing authority has unfortunately been deferred maintenance over the years. I guess you're trying to improve that?
Yes. So Brian Clark is here. Maybe be able to answer that question.
Go ahead, sir.
Yes, certainly. The deferred maintenance is a significant challenge for the agency. And the average age of our buildings is up over 50 years now. And then with the some of them we've implemented already. So, for example, we do apartment inspections. We try and get into each apartment at least once every 2 years. And in the past, the way that we were doing these inspections was we'd have a separate inspection force going out there. They weren't doing any work in the unit while we were doing the inspections, and then would report back and create additional work orders, which was increasing backlog. We feel that anytime you're inside an apartment is an opportunity to make repairs. So now, as we're doing inspections, we're making simple repairs, and that's helped us overall with our service levels for simple repairs. Last year, our average maintenance service level was almost 2 weeks, and now we're down to 5 days because of this program. One of the things we're implementing this year, we started it already at 9 developments, and with our exterminator operation in certain areas of the city, is moving to handheld devices. We've been very, very much a paper-driven agency, and we're getting away from that. And what this does is improve the accuracy of the data, the more timely deployment of staff, to our apartments, and we have an emergency, situation. Less handoffs and less checking back to the office, which creates overall efficiencies. So we plan to have handhelds deployed to all of our maintenance and skilled trade staff by the close of this year, which would be over 3,500 staff. We are also doing a business process review of each one of our. The way that we're organized is we have very much our staff or our union staff with clearly defined roles and responsibilities and job descriptions. So we're doing actually what we call a business process review of each trade, where we're mapping out the as-is process, identifying opportunities for improving efficiencies and cutting out waste for each of our trades. We've completed our review on our extermination process. And we've already seen improvements in that area, where we were up almost 10 days in for an average service level, where we're down to right around 4, a little less than 4 as our service levels, and we're moving through each one of our trades. So we are and there's lots of other strategies that we're doing as well to try and improve our overall maintenance. We do have finite resources, which makes it a challenge for us, but we believe we can do better with what we have, and we're trying to do that.
And just to make a separation, we have a $17 billion physical needs assessment on our properties. And so that's capital, sort of separate from operations, which obviously Brian is a key member of that group, and trying to work down those work orders. On the capital side, we receive, hundreds. I said we have a $17 billion need. We have hundreds of millions of dollars that come from HUD every year to address that capital need. And so while we're doing these things on the operations side, and we're doing well and have a lot of initiatives in place, I mean, quite frankly, our challenge is more on the capital and the replacement side.
Yeah. All your projects are now federalized, right? No project is being supported by city or state funds. Those are like just separate subsidies.
So we had picked up 20,000 units in unfunded city and state units some years back. About 11,700 are, have been, we receive public housing subsidy on, and then we have the, 3,000 or 4,000 that we have converted to Section 8, and we still have about 4,000 plus units for which we don't receive a subsidy.
I see. But basically, HUD is critical to this agency, am I correct? HUD funds are critical.
Absolutely.
Yeah,
yes.
The HUD funds are critical. And of course, the fact that the city and the state do give subsidies is extremely helpful. In the rear, I don't remember the page, I'm sorry. You made the notation that you, had a reserve against your inventories, that where you felt some of it was obsolete. I thought that was good. I really do, because the city years ago had storehouses. When we went through a fiscal crisis, we found out that a lot of it will never move. And I think I commend you for that. It's a conservative thing to do.
Thank you. So, so essentially we wrote down inventory that was moved out of storerooms because it was deemed not necessarily usable, and we kind of established value based on some sales that we had.
Yeah, no, that was right.
So it's really the inventory and the value to the authority is kind of the thought process.
And the waiting lists for the apartments are still so large?
It is. I think part of the challenge, too, for our Section 8 program is really finding apartments that will take the voucher, and I think that's part of the reason.
But I think the regular apartments, I remember somebody saying the waiting list is enormous.
For the public housing, Brian, you want to speak to that?
So, sure, yes. It's close to 300,000.
Application.
We moved away from paper applications to doing it electronically. So that improvement has made it more accessible to apply, and we've certainly there's a great need for affordable housing in New York City, and we have a long waiting list, that's for sure.
I'm sorry, just for clarification, that's a waiting list of people who you know to be qualified, or?
No, so the application is filed, and up front, some folks will be informed automatically, like, for example, based on income limits, right? But there is a second level that requires, at the time when we want to reach them, we're going to conduct an interview, criminal background check, all that other stuff. So we have, off of that, I think it's around 15,000 folks have been, certified. Our turnover is very low each year.
Yeah, people don't
Thank
move.
you.
There's no place to move.
So what's the time wait on someone who is certified? How long?
Yeah, so generally when someone is certified, I think it's right around. We think we're going to be able to reach them within 9 months.
Go ahead, Mr. Khan.
Thank you, Mr. Chairman. On page 69, 68 and 69, the discussion on pollution remediation obligations, you say that you reached in 2006 a consent order with the state on becoming a potentially responsible party. Can you go into what the total liability is and how quickly you are moving to remediate that, especially with regards to the environmental issues of oil spills and your fuel tank storages, but also equally importantly on page 70 with regards to lead paint and asbestos remediation? Could you go into a little more detail about that?
So perhaps Brian could espouse on the DEC part, and I'll talk about the numbers.
Yeah, do you want to start with the numbers, Jeff, and then I'll go with
Sure. So essentially for pollution for the fuel tank and oil spills, we have a $7.2 million liability on that. And it's calculated in accordance with GASB 49. It's a little complicated formula that we have. It's actually a GASB formula that takes into account how much we think we're spending a year, how much we spent a year, as well as how long we think it's going to take us to close spills, or if not closing spills, how much that's going to cost the authority. As far as the asbestos and lead-based paint, that's related to some capital work that we're doing. And in 2014, we, again, with HDC's assistance in financing, we went through we have a Bond B, we call it Bond B, where we got financing to do roof work and facade work. And what happens is, and that liability is $27 million, 27.5. And what happened there is, for accounting purposes and probably for realistic purposes, once we do some work, crack open a roof, or start doing the facade work, there's lead-based paint in the brickwork and the initial brick. So we're required to actually record the expense and liability at that point in time. So because we received the financing in 2014 and we started, or actually late 2013, most of the work was really underway, and we actually initially started that facade and roof work, is when the exposure occurred, and that's when I had to incur the accounting expense and liability. Because that work is ongoing and that was recognized in 14, 15, we had already recognized those expenses for about 25 to 27 different developments, is why we didn't have the reoccurrence of that cost.
So
the
the
special
cost-
financing that kind of associated with the implementation of doing that work.
So the liability you state is based solely upon when you start work on a building. It's not your total liability.
Right, when they reach a
across-
certain point, and we get that information from our capital division.
And this is more of a policy question, but I mean, the exposure of lead to children especially is very concerning. Are you working with the Department of Health or with other agencies as far as the mitigation of lead dust as you engage in construction?
Brian?
Yes. So that first off, with any of our, I'll speak to. I know you had several operational questions, so I'll answer this one first, and then I'll loop back into the fuel oil tanks, asbestos, and lead-based paint. So anytime we do capital work, part of the design process is to see whether or not we're going to be impacting lead-based paint or asbestos during the course of that work. That's the asbestos is a regulatory requirement of the state and the city, so that we have to, in order for us to get our work permit, we have to make sure that we've identified it and that it is abated as part of the overall work, meaning that it's removed, whatever is going to be impacted by that. Regarding lead-based paint, we identified prior to as part of the design process whether or not any lead-based paint is going to be impacted, and then that would be incorporated into the scope of work as well. What I'd like to do is just loop back really quickly to the fuel oil tanks, and then I'll go take you through as I laid out before with the lead and the asbestos. So with the fuel oil tanks, first off, I just want to go over the definition of a spill. It's a very rigorous definition. So the way it works with the state is all petroleum spills that occur in New York State must be reported within 2 hours, unless it meets all of the following criteria, which is the quantity is known to be less than 5 gallons. So anything more than 5 gallons got to be reported to skip the spill. The spill is contained under the control of the spiller, meaning that, let's say it was on concrete, and was quickly picked up and remediated, and that would only be if it's less than 5 gallons. The spill will not reach any of the water or land, and the spill is cleaned up within the 2 hours of discovery. So anything else outside of that has to be reported as a spill, and then there has to be an actual plan, to address it. So we report the spills to the DEC. The DEC will respond and send somebody out there to observe the spill. We actually have staff on board who are trained, and we have the equipment to respond to spills, as well as contractors. When you look at our overall open spills that we have right now, we have 94 active spills, which is down from 116 from 2014, which means that we've been able to successfully remediate and close 22. Closing out a spill is it's a very technical and complicated process. It all depends upon the amount and where. Most of our spills, some of them can be related to delivery, but most of the spills are due to older tanks. Many of the tanks at that time were single-wall tanks without automatic leak detection equipment. Soil is corrosive. It will eventually corrode the tank, and you have a leak underground. When the leak is underground, there's a couple of different ways of remediating it. Some of it requires excavation, completely digging down, but if it's reached the aquifer, the underground water, water stream, then you have to actually set up monitoring wells, keep positioned, you have to do a site investigation, then you have to, that has to be approved by the DEC, then you need to have a remediation plan, based on, then you do your investigation, then based on what that tells you, then you have to actually put together a remediation plan, which can be monitoring / pumping wells that will capture the oil under the ground and pump it back up. And in other areas, we actually have active systems, oil water separators that will pump the oil up out of the ground. The lengthy process can take a lot of time, but we've had a lot of success in this area in reducing the spills, and we'll continue to do so, and work very closely with the DEC on that. In order to reduce our risk, first off, most of our sites, our heating plants are what we call dual fuel. They have the ability to use oil or natural gas. We have a very favorable rate, with firm gas. So most of our sites are on firm gas, and in fact, we've been closing up some of our tanks because of the risk with oil. So we predominantly use natural gas, less deliveries, less risk of spills. So and then also anywhere that we put in new oil tanks, They're double-walled and come with a leak detection monitoring system and alarms. Then I'd like to move to asbestos. As I said before, it's a very highly regulated item, very common construction material, especially based upon the construction of our buildings when they were constructed. The housing authority still has asbestos in the buildings. It's in the a lot of floor tile has it. It's considered non-friable material, but when you have to disturb it, you still have to follow all the rules and regulations. Roofing material, as well as flashing cement on our roofs, and then thermal insulation, pipe insulation associated with our heating plants. The golden rule with asbestos is where you have it, maintain it in good condition, and then when the only time you remove it is when you have to disturb it, and then you want to make sure you follow all the rules and regulations. Housing Authority is in fact a licensed asbestos contractor. We have licensed handlers that work on our staff, as well as licensed investigators, and we can respond quickly to emergencies. We also use contractors. Predominantly our abatement work is done with contractors. They're all licensed. All of this work has to be filed with the New York City DEP, as well as the state DOL, as well as the EPA, and then any of the waste has to go to a certified landfill waste site with really close monitoring and tracking in the form of manifests. Also, air sampling has to be done anytime the material is disturbed. We do during samples during the work, and then clearing samples to make sure the area is okay. Has to pass both a visual inspection and an air inspection. Overall, now I'd like to move on to lead-based paint. Overall, lead-based paint was banned for residential use in 1960 in New York City here, and throughout the country in 1978. Federally subsidized housing has very rigorous rules and regulations related to lead-based paint. Housing authorities were required to test for lead-based paint, characterize the lead-based paint in our developments based on what's called a random sampling, provided that the developments meet a certain criteria, which is same construction materials built around the same time, and same paint history. Housing Authority qualifies for all that, so we did a random sampling and characterized lead-based paint at all of our pre-1978 developments. The lead-based paint was a quality paint additive. It was more expensive than non-lead-based paint. The Housing Authority never specified lead-based paint in their contracts, and so our paint work is competitively bid. So the upside is that we don't have a whole lot of lead-based paint, but anywhere you do, it's an issue and it's a concern, and there are definitely regulations and compliance requirements that are really quite rigorous. There's a number of regulations that we have to comply with. One is informational. This is the Federal Disclosure Act of 1996. We're required anywhere that we have lead-based paint information regarding abatement or testing has to be shared with our tenants at lease-up, and anytime that information changes. So, for example, if we do any work within the building that could potentially impact the tenants, we have to provide them with updated information regarding that. Like I said, we did random sampling of our developments, characterized it. We use that as part of our modernization planning. So anytime we have modernization work that's going to impact these surfaces, we include the abatement, the control of the lead-based paint as part of that overall work. And then to your point about dust sampling, we do what's called periodic risk assessments, where we're going to go out and we actually do some soil sampling and dust wipe sampling, at our developments. And then based on what that tells us, we have to do certain follow-up actions. New York City regulations in 1994, you had Local Law 1 of 2004, it requires a number of things of landlords. One is upon apartment turnover, anywhere you do have lead-based paint or the presumption of lead-based paint, you have to abate it from friction impact surfaces, such as door frames. What the Housing Authority does is where we have either we know that we have lead-based paint, or we presume it that we have lead-based paint, we test those units, and then what we do is we completely abate those units upon turnover. Also, we're required to include certain information at lease-up regarding this regulation, which we also provide. And then each year, and this applies to everybody in New York City, the landlord has to send out an inquiry. It's paired with the window guard inquiry, asking for the age of children, in this case for lead-based paint, for children under the age of 6 if they're in the apartment unit. If they are, it requires a visual inspection of the unit, And if it's found that those surfaces that contain lead-based paint are in peeling conditions, you have to make them lead safe, which is basically restore the the surfaces. And we are in the midst of doing those inspections right now.
Thank you. That was a very thorough response. I appreciate that. My next question is on page 101, just getting some clarity on your lease commitments. In 2020, your lease commitments dropped down to $7 million, I believe. Could you, is that an aberration, or is that just when a lot of lease end, a lot of lease are come up? Expire.
I have a feeling it's an expiring lease, right?
Yeah, those would be when the lease agreements expire.
Okay.
Right, so basically leases expire, we don't have the commitment anymore. That's why if you look at 21 to 25 on average over those 5 years, it's around the same number because you have leases expiring probably, after 2019.
Okay.
You expect to pay a lot less rent, is that it?
Expectation to pay rent, I don't know what the well, maybe
All
see
right.
if I can answer that. Basically, these are just plain and
doesn't-
simple expiring leases.
I think the big lease is the lease on, for our central office at
Where are you located? Where is your central office? On
250 Broadway.
250 Broadway.
Across the
No,
park.
it's not the Broadway. Well,
It's just, it's not.
I don't think it's that serious.
I mean, the thought is, quite frankly, that we're going to consolidate with 90 Church, which is where a lot of our other offices
Sure.
are. But that's the lease that's rolling off.
Sure.
Just a couple more questions, Mr. Chairman.
Sure.
So
We get it.
this goes to the procurement issue and warehousing of your supplies. I mean, that's come to light recently of those issues, and I mean, I'm sure you've known about them for a longer period. But I think part of it's, the paper issue now, maybe digital, but what reforms are you making? How quickly are you addressing those as far as your internal policies, as far as maintaining supplies and equipment?
We have closed a lot of those warehouses. Brian, is it 4 out of the 5?
5 out of 6.
5 out of 6. So we've literally wound down most of those warehouses.
And what was and you just threw away those materials that were in there? Like, I mean,
No.
We reviewed what was in there to determine what was usable and what we needed to move either to developments or to that last remaining site.
okay. The next question is, HUD, I believe, recently issued an order with regards to having the availability for broadband in public housing. And it's one of the issues the public advocate has discussed as we've worked to address the franchise agreements with Time Warner Cable when they were being acquired by Comcast and then by Charter, and also with regards to Cablevision. What is the current availability of broadband in NYCHA, and what's the availability?
Brian or Bob?
The availability is based on Time Warner and Cablevision and Fios and what their contracts with the city are and where they're allowed to have.
So it's with the franchise agreement.
We have broadband at every development available at one of those suppliers depending on their locations. And of course Fios is throughout the city, but Verizon has been very slow in implementing Fios in some of our developments. And City Hall is pushing, Maya Wiley and her team is pushing hard to have Verizon commit to rolling out the rest of Fios to the rest of the city.
Right now, they're about a year behind, or more than a year behind their commitment that they made to the city with
Sandy
regards.
impacted them, their strike impacted them, they have a bunch of reasons, so they say.
So also the actually, I'll hold off for now.
Okay.
Thank you.
Could I go back to page 97 on Sandy?
97, Bud?
Page 97. It says that there's no change in your estimate of cost. I'm just curious, how much of that work's actually done? Have you done most of those repairs and therefore it's unknown, or there's a portion that's still future repair work?
From the accounting perspective, the cost that the estimates haven't changed is really the expense, the expense cost as opposed to mitigation and remediation. So changes in
No, question, you
right.
have an estimate of 332. Is that including a significant amount of future work, or is that work that's basically been done?
Most of the work's been done, but there's some work ongoing or future work because we have a $60 million accrual for Sandy, and that's for the same type of work that's we've been doing.
That $60 million
That's-
accrual is included within this 332?
Yes.
Because that's what I was trying to get
That's
an
correct.
idea of.
Right, so
You say
that's-
that there's no change in the number, but how much of it is potentially work still to be done? So you're saying
Right.
there's an accrual
It's-
of about $60 million.
Right, so it's relatively small, and that's basically repair work. So
And you're-
replacing the same type of functionality that
And
we've had in the past.
As indicated here, you're comfortable that that's going to be covered by insurance or FEMA?
Yes, because that's either insurance or FEMA covered, and we expect to get most, not every dime, but most of that money back between the two sources.
And to date, you have had a good track record of getting that money, right?
Yeah, so we're continually working with insurance. FEMA, we're also working with very closely on that. And so we're trying to coordinate our costs between the reimbursement parties, and that's kind of how we're looking at things.
Curious, on timeline, if you still got $60 million of work done, how far out is this running?
Actually, we expect to run through that part of the accrual this year.
So you basically anticipate being completed this year with the repair work necessary as a result of
Right,
Sandy?
and then we're going to move on to more of mitigation and hardening.
prevent.
Right.
Okay, thank you.
I was just curious, but as long as you raised it, does the insurance company then go after FEMA for some of the money, or no?
No, I think it's the way it kind of works in the, from my
FEMA
point of view,
wants-
is FEMA is kind of a wait and see. They want to see what insurance is doing first, because they'll reimburse what's not insured up to a certain percentage.
And you'll continue to carry insurance?
Absolutely.
Absolutely, you must have.
Just one last question.
Go ahead, Mr. Khan.
So, two questions, sorry.
Go ahead.
With regards to, you mentioned 18 billion in deferred maintenance for the properties?
And that's our physical needs assessment. It's
That's-
17 billion. Yes.
17 billion. Within that assessment, what is there a prioritization with regards to your internal evaluation, and is that documentation made public as far as what the needs are for each development?
I don't. I'd have to ask Brian if it's by development. I certainly can tell you that what we do is we look at sort of the how it plays out. So the building envelope is obviously the first priority, which is why you've seen so much work being done on roofs, because obviously if you can't get the building envelope secure, it doesn't make sense to do anything else inside the building. But Brian, do you know if it's?
Yeah. So the needs assessments are conducted by property, and they are there is a prioritization system for the urgency of the of the work, depending upon the condition of the particular component that's being assessed.
And is any of this made public, or is this?
Yeah, it's I believe there's a link on our website for it. And we're undergoing our updated needs assessment now, which should be completed. I believe we can get you it's next year. I think halfway through next year, I think is when it is. Yeah.
Okay.
Yeah.
And then the next question is just for the for Deloitte. In your assessment, I think you just provided a letter, a 2-page letter for NYCHA, if I'm not mistaken.
You say we provided a 2-page.
You have a.
That's the opinion?
The opinion, right.
Your opinion letter.
No, it's your no material weakness letter.
Oh, okay.
I mean, I was trying to find.
No, we have a management letter, Michelle. Yes, I'm
yeah.
curious. Refer me to the 2 pages.
Oh, I didn't get that.
It's a separate handout, Mr. Khan.
Thank you, Mr. Chairman. Well, I will review this and then get back to you.
Okay.
Regarding that. Thank you.
A lot of it relates to computers access and things like that.
It came separately.
Okay, so we should discuss that. Thank you.
There's nothing astonishing in there.
All right, we'll get him a copy.
Here it is.
Thank you.
If there are no No further questions. Thank you all.
Wait, did you have
Very
any
good
questions on
job.
the management?
Very nice set of statements.
Okay.
Really.
If
Thank you.
any of the members who didn't have a chance to look at it in advance have questions on the management letter, could we ask them, give them to the
Your
secretary?
best bet is send it to Jackie, our worthy secretary, and she'll distribute the answers to everybody. Good.
Thank you.
Thank you all.
Thank you very much.
Thank you.
Good place for airplanes.
What are we going to do? It's big agencies. Who's next?
Actually, this meeting,
They'll be
this
fast.
committee's taking longer. There, I had fun getting the fun. My first session. But it's hot.
She's right, impressive, the chief financial officer and the other. They're a good crew.
At the head of it, woman
Well,
who
I
was
happen to
the woman
like.
who was sitting in the back.
Yeah.
She's real stuff.
No, they're doing a good thing. They have to. It's a.
No, I was in a big turnover there, and I was very impressed with the people.
Good. Hi, how are you?
Morning. I got a 1:30 lunch.
You got what? You better cancel it.
No, I can't cancel that one. I'm paying the client.
You're at a loss because I'm fasting, so I got all day. I got until sunset.
Could you quickly introduce yourselves? Let them get his papers.
Yes, thank you. Good morning. I'm David Beester, the acting president and CEO of the WTC Captive Insurance Company. With me today are Jim Schoenbeck on my left, the CFO of the WTC Captive, and Todd Thiesfeld on my right, a partner at Crowe Horwath, our auditors.
Where are you located, Crowe Horwath?
Well, we're in New York City, but I'm out of the Hartford, Connecticut office, which is where most of our insurance practice currently is.
I wouldn't figure either that.
Yeah. Yep. So we have a New York City office, but I'm currently out of the Hartford, Connecticut office, which is
Yeah,
where the
large
majority of our
insurance practice, I guess, yeah.
over 400 insurance companies.
What?
You're the descendant of Laventhal Horwath, aren't you?
No. Our past life was Saslow, Lufkin, and Buggy, so we were about 100 people, a boutique firm in the Northeast that specialized in insurance.
Oh, so Horwath is not the old Horwath?
Well, Crow, yeah, that I believe. I think they are, but I think there's some different stories.
You're getting Todd into trouble at the company lunch, I think.
One of your ancestors.
We're relatively new. Our firm rolled up to Crow Horwath about
One
a
of
year
your
ago.
ancestors was my accountant, but that was 30 years ago.
Thank you for the letter on the deposit accounting. It's always helpful. Let me just go to the main question. What did you pay in 2015 to claimants, for want of a better term?
Well, we had total loss payments of about $30 million in 2015. And of course,
those previous.
Well, what it mostly was was payments related to the debris removal settlement with the 10,000 claimants. So, and two components. One was about a little over $10 million that represented contingent payments under that settlement, and $17.5 million which represented the resolution of a dispute of how much bonus payment was going to be due under that settlement. So those two elements together were about $27.6 million out of the $30
30
million.
in round numbers, gotcha. And how much, I guess, what do you have available for future claimants?
Well, the company at the end of 2015 had net assets, and essentially all of our assets are available for future insurance activity. We had about $294 million as of the end of 2015.
So you still have. And
authority from their meeting.
What does your charter provide for your continuance?
We are chartered to an initial term out to 2029. And then there are various provisions for what happens with remaining assets at that time.
I'd like to be there when you expire.
A lot of people,
I'll be 99.
I think, go for relief to the Health and Hospitals Corporation. They have a few clinics as well.
What's that have to do?
Right. So there are a couple of other programs. The Health and Hospitals, along with Mount Sinai and a couple of other private hospitals, both in New York and in the area, receive funds through the federal government for care of individuals who became sick as a result of working at the World Trade Center site. Our program is a little different. It's the third-party liability insurance in case of actual lawsuits against the city and contractors. But there is certainly an overlap in the kinds of things that we would pay for.
And do your actuaries make any projections about your payments then in the near future, or the claimants, or?
Right. Well, our actuaries, when we have actual claims, our actuaries will help us determine a reserve on those claims. The unknown, incurred but not reported loss component, which would be a projection by our actuaries about what they think the future liability will be for claims that are as of not yet reported. Our actuaries continue to say that with respect to this event, that's not estimable because it was so unique in terms of its nature and in terms of what the exposures might be, and they don't have a history of similar activity that they can look to and say, well, based on similar activities in the past, this is what we might expect over the next 20 years. So currently, we do not report an IBNR figure for incurred but not yet reported claims.
Did I read correctly that as of the report there was one open claim?
That is correct.
By chance, has that been resolved since this was done? No.
No. We still have an open claim.
And when was the last time a claim was initiated?
Well, we had 2 lawsuits that were filed in, I believe, 2014. We have the claim that's not yet resolved has not yet reached litigation, and we're hopeful to resolve it without it getting to that point. So that's an outstanding claim, but the most recent lawsuits were 2014.
Activity, there was a massive amount of claims that were filed shortly after the event. And since that point in time, we're following down the curve. We have not seen any significant claims in the last 3 or 4 years.
Right, and that's largely explained by the reopening of the Victim Compensation Fund, which was also renewed towards the end of 2015, running through 2020. So it's not that people aren't seeking relief, it's that they're seeking it through a no-fault means rather than pursuing litigation.
Which is the purpose that was set up, right?
Exactly.
So in a sense, it says it's working.
That is, yes, the system seems to be working both between the VCF, which acts, has an earlier end date projected to 2020, and then, of course, the VCF does not require people to participate in it, but if they do, they're not allowed to file a lawsuit. If they choose to file a lawsuit, they're precluded from a VCF recovery, and then that would be where we would step in.
And can I file a VS victim complaint right now?
Depending on when you found out you were ill, you could file a complaint right now, yes.
It would have to be a recently identifiable complaint.
It would either have to be something that you recently discovered in terms of an illness, or it would have to be something that more recently became covered by the VCF. They didn't, from time to time, they update the different types of illnesses and that they will provide compensation for.
Does that process run out to the 2020 date? So if in 2019 something materializes, I would still be able to enter the VCF?
That's correct.
Does the master, is there still a master involved in the payments?
In our payments, we had a separate, a third party that reviewed the medical information from the different settling parties, but since we made our final payment under that program in January of this year, we keep in touch with them, but they're not doing anything for us right now. At the VCF, the current special master is Sheila Birnbaum.
My former partner. She left us.
Yeah.
I have a couple of minor questions.
Go ahead.
You're not a taxpayer, so why did you own municipal bonds? Were they taxable munis?
Our investment manager would have bought municipal bonds to the extent they had an absolute yield advantage relative
That's what it is, okay.
to taxable investments.
And another question apropos of that is, since presumably you're going to hold all your fixed income to maturities, but you've recorded, I'll find it here, you recorded a loss here, I guess from the decline in the value, but sometimes you see that people don't record that loss if the intention is to hold it to maturity.
Well, I mean, we're on a fully mark-to-market basis, so there could be mark-to-market losses that we would take, and from time to time, depending on the circumstances surrounding a purchase and the value at maturity, we might even incur a loss. But I would think the short answer is just that we're on a full mark-to-market basis, and so if the change in value is a loss, we're going to take that through the current period in our investment.
I have seen similar situations where you take the position that you're holding the instrument to maturity and you don't record a loss in your accounts.
That is not
That's
how
not-
we account for our investments.
Okay. Why?
Because our accounting guidance, and I'll let our Todd Thiesfeld, our
it's
outside
mark-to-market
auditor.
under GASB 31, so we're fair value.
Okay. I have nothing else other than the fact you should capitalize the V in city.
You have a small staff in the office, is that it?
That's correct.
By the way, do you lend the securities from your portfolio?
No.
No.
All right. I have nothing else, Bernie. All right.
Do any members of the committee have any further questions of the World Trade Center?
Just a very quick question. Actually, I'll skip. Thank you. Sorry.
Okay. Thank you again for coming, and thank you for your letter. And what's the...
Good luck.
Thank you very much.
Thank you. Used to be Laventhaw Hallway. Jacobson, Greenfield, Laventhaw Hallway. Well, Danny Jacobson's father started that from it. Danny was my accountant for 10 years. So I know the history. They were the leading firm in restaurants, or one of the leading firms. That gives me time to get a glass of water. You want some, Mike? Yeah, I'll take a cup of water if you don't mind. Okay.
People represent the Transit Authority?
Yes, this is the Transit Authority and Sertoa.
So you'd be good enough to introduce yourselves?
Yes. I'm Bill Vazoulis. I'm the controller of the New York City Transit Authority. Sitting to my left is Jackie Ospina. She's the Director of Operations Accounting for the New York City Transit Authority. To my right is Doug Connett. He's the Vice President and Chief Executive Officer of Sertoa. And sitting next to him is Neil Breitkopf. He's the Director of Finance of Sertoa. And sitting next to him is Maria Burgos. She is the Assistant Director of Finance and Timekeeping for Sertoa. So, yes, I'm going to go over the financial statements of Transit Authority first. So the finances of New York City Transit Authority remain very stable for 2015 as a result of increased revenue from our March 2015 fare increase, increased property tax collections due to the strength of the New York City real estate market, and increased revenue from toll collections due to increased traffic at the Triborough Bridge and Tunnel Authority. There was a slight decrease in our ridership of 5 million passengers, or 0.2% from the prior year. Ridership was slightly lower due to the result of the effect of the fare increase and the effect of lower gas prices, which caused some of our passengers to switch from mass transit to their vehicles. The operating statement reflects a net surplus for 2015 of $663 million, compared to a net surplus of $54 million in the prior year. A majority of the surplus in 2015 was due to the effect of the implementation of GASB 68, which had the effect of reducing, for accounting purposes, the current expense of the post-retirement benefits other than pensions. I'm now going to go through the statement of revenues, expenses, and changes in net position to describe the key items that moved from 2014 to 2015. I'll start with the statement of revenue and expenses on page 18. Revenue from fares increased from $4,611 million in 2014 to $4,827 million in 2015, an increase of $215 million, or 4.7%. This increase is primarily due to the annualization of the March 2015 fare increase. Total paratransit revenue and funding was $208,500,000 in 2015 compared to $194,100,000 in 2014, an increase of $14 million. Paratransit expenses were $462 million in 2015 compared to $455 million in 2014. There was an increase of $7 million, or 1.5%, due primarily to operating issues with the voucher and broker service providers that resulted in us switching some of the trips back to the primary carriers at an increased cost. This was offset by lower fuel costs and also lower fleet maintenance costs because we did not need to increase the fleet.
How'd you do in your hedging on your fuel costs?
The hedging is, I think it's been a mixed bag on there, but
it was a bag. I had worked for a little while at the authority, and it was a loss then too.
Yeah, it's always a hard thing to
City people,
get right.
Government people shouldn't hedge. Pay and that's it. Go ahead.
Pay as you go, especially in the case where it's dropping the way it was.
Somebody's making money out of that hedge.
Yeah, they do. They do, unfortunately. Advertising and other revenue increased by $22.1 million due to an increase in advertising ad placements in 2015. Operating expenses decreased from $10,518 million in 2014 to $9,996 million in 2015, which was a decrease of $522 million, or 5.2%. Within operating expenses, salaries and wages were up $80 million, or 2.3%. Payroll increased by 1.2% as most represented and unrepresented personnel received wage increases in 2015, and headcount increased in support of various maintenance programs and operations requirements. Overtime expenses increased by 10.6%, due mostly to maintenance, unscheduled service, and vacancy absentee coverage requirements. Health and welfare expenses increased by $74 million, or 11.1%, due primarily to rate increases. Pension expenses decreased by $355 million, or 39.1%. This resulted from the adoption of GASB 68. Post-retirement benefits other than pensions decreased by $490 million, or 24.6%. Based on the most recent actuarial evaluation, we posted an adjustment which reflects a significant reduction in pharmacy claims due to the introduction of an employee group waiver plan. As the EGWIT plan has saved us a lot of money in that area. Fuel expenses decreased by $70 million, or 40.7%, due mostly to lower fuel prices for our bus fuel. Public liability claims expenses increased by $37 million, or 25.2%, due primarily to the actuarial valuation update, which reflected an increase in claims. Mostly those claims are in amounts as opposed to...
Your public liability claims are not on a cash basis. You actually do evaluation.
Yes, we do
an actuarial valuation, and you deposit.
Correct. We base it on historical experience.
That's fine.
Exactly. Yeah. The professional service contracts expenses decreased by $30 million, or 2.4%, due primarily to the MTA consolidation of IT functions. Paratransit service contracts increased by $14 million as a result of operating issues mentioned earlier with the voucher and broker service providers that resulted in trips being reassigned to the primary vendors. There was a slight decrease in the volume of trips, 0.8%, from 6,414,000 to 6,360,000, or 54,327 less trips.
The city is paying more for the paratransit than they did initially, right?
Yes, yes.
Which is helpful.
Yes, it's an expensive program, so
sure.
Depreciation expenses increased by $172 million, or 11.3%, due to the capitalization of construction work, new station rehabilitations, track work, signal enhancements, new buses and subway cars in 2015. Moving on to non-operating revenue, tax-supported subsidies from New York State increased by $34 million, due primarily to increased petroleum subsidies of $51 million and increased Metro Mass tax subsidies of $33 million, offset by lower payroll mobility tax subsidies of $50 million. Tax-supported subsidies from New York City increased by $176 million, due mainly to increased collections of New York City mortgage tax due to the strength of the real estate market in New York City. Tri-Borough Bridge and Tunnel Authority support increased $13 million due to growth in traffic volume from $286,400,000 in 2014 to $297,900,000 in 2015, an increase of 11,500,000 vehicles, or 4%. The increase in traffic growth was due to lower gas prices and favorable weather in 2015. Skipping to capital contributions, there was an increase of $194 million in capital contributions due to increased capital expenditures funded from several sources, including bonds, federal, state, and city funding. The net result was an improvement of net position from a surplus of $54 million in 2014 to a surplus of $663 million in 2015. On the statement of net position on page 15, in the assets, cash and MTA investment pool combined was $583,173,000 in 2015, compared to $342,294,000 in 2014. The increase is primarily due to the timing of when we received cash reimbursements from MTA headquarters for capital projects. Due from MTA and constituent authorities increased $70,029,000 due to improved collections of intercompany billings for services provided to other MTA agencies, mostly MTA bus. Material and supplies increased $36,367,000. This increase is primarily due to the stock of inventory and supplies to support the capital program and the maintenance of new models of buses and subway cars. Most of that is the capital program because we stock material in our supplies before we issue it to the different capital projects, and it ends up there in this number. Capital assets increased by $1,266 million. The increase was due to additions of $876 million to construction in progress, $640 million for stations, $409 million for track and structures, $464 million for buses, $187 million for subway cars, $134 million for signals, $29 million for service vehicles. This was offset by depreciation of $1,692 million. Significant projects of note are the substantial completion, the start of revenue generation of the number 7 extension, the expected completion of the 2nd Avenue Subway Phase 1 project from 61st Street to 96th Street, which is scheduled for the beginning of revenue generation in December 2016. The start date, however, presently is at risk due to delays in receiving and testing necessary police communications equipment by a contractor. However, the target date is still set for December 2016, pending remediation attempts by the contractor to get that equipment in place and to have it tested by the police. Sandy recovery and resiliency work is ongoing in the tubes crossing the East River and then the rehabilitation of the South Ferry Terminal. Eastside access completion is expected in December 2022. Mining has commenced in the Harold Yard and the tunnel shield in Manhattan has started to be installed. It's expected to be completed.
That east side access is a long time.
It's a long way away, but it's getting started finally.
Yeah,
so, or it has been started, but it's actually funded now to keep going. Coming up in the future will be the purchase of 300 CBTC-ready B Division R179 subway cars, which had been delayed due to structural problems, but are now fixed and are expected to be delivered from June 2016.
I'm sorry.
From whom are you buying them?
The subway cars are
Some of us Kawasaki.
Kawasaki.
Yeah.
Yep. We're also purchasing.
You either buy from Kawasaki or Bombardier, right?
Correct. Exactly. Yes. We're also purchasing 128 CBTC ready A Division R188 subway cars and converting 380 existing R188 cars to CBTC ready.
Okay.
As part of the rollout of the CBTC technology under the 2015 to 2019 capital program, we plan to purchase 940 CBTC-ready next-generation R211 cars.
That program hasn't been approved yet?
That has been approved now.
At the end of May. It was approved, I believe it was May 23rd.
No, from 15 to 19?
Yes, it was approved.
Yes.
That's your latest cap?
Yes.
Yes, we have approval now, so we're going ahead now, and we're really going to
that's
account.
good.
The one change was they want most of the projects to be completed earlier. Instead of 5-year, they want 3-year.
It's about a $28 billion program?
Yes, exactly, $28 billion, and it's quite an undertaking to do that under a shorter time frame.
You're a very intense capital agency. It's understandable.
Yeah, these we're looking forward to the CBTC technology. We're really looking forward to getting that CBTC technology in place, though. That will really make a big difference. We also have 3 contracts that are in place to start delivery next year of 354 standard buses, 300 express buses, and 234 articulated buses that are needed to replace our aging bus fleet. In the liability section, the increase in total liabilities of $6.646 billion was primarily due to an increase in the pension liabilities of $5.596 billion as a result of the adoption of GASB 68.
In other words, you saved it 1 year, but you'll be paying it later.
Exactly. It's just the accounting entries, really.
Okay.
An increase in post-retirement benefits other than pensions of $1.130 billion due to the booking of reserves required by our actuaries, computation of the liability for post-retirement medical benefits, and an increase of $281 million in liabilities arising from injuries to persons due to higher settlement payments levels and an increase in large case reserves. So that's the completion of
Very good presentation. Thank you. But the 2 major pensions in your place, of course, are NICES. You're a member of the New York City Employees Retirement System, and MAPSTOA.
Correct. That's correct. And MAPSTOA is, we're continuing.
What is the total head count of the Transit Authority? Approximately 40,000?
It's about 40 to 50,000, 45,000, 46,000.
So MAPSTOA is about 8,000, 10,000, and the rest is NICES.
NICES, correct.
Yeah,
right.
NICES, yeah.
NICES is the big chunk of it. And the pension plan, MAPSTOA, has $2.3 billion of assets, and it's funded about 67%.
No, that was a great thing that they did because it was a bankrupt organization and pay-as-you-go pension, and a little more money at the beginning helped get it started. Very well done.
Yes.
Yeah, that was well done.
Mm-hmm.
All right.
So we can say questions on transit, and then we go on to CERTOA. If there are any.
No, it's a very complete report.
And then I'll have Jackie Ospina who can go on.
I think I mentioned to one of your predecessors, you say in the city tax-supported subsidies that the sales tax is 1/4. I believe it's 3/8.
It's 3/8.
I really believe it's 3/8. It had been 1/4, I think, when it was 8.25% in the city, for the state, and 1/4 for the TA. Now the sales tax, not now, for a while it's been 8 7/8.
Right.
So I think the 3/8 was for the TA, and the other 4/8, forgetting the 4 and the 4 split, are either city-state split, or one of them got it. I don't have the exact numbers, but you ought to look into that.
Yeah, we will.
It's a helpful number. I mean, if it's 3/8, it's 3/8.
Mm-hmm.
The other thing is, without the mobility tax, I don't think you'd be in business.
Yeah, the mobility tax is definitely essential. I mean,
essential.
all these taxes are critical, and
critical.
And the real dynamic is that the ridership decrease, which is something that's happened last year, and it's continuing into the current year. And there's a slight decrease, but it's we were budgeting for a slight increase.
Yeah, no.
So now we're short of that revenue, but we're saving money on the lower fuel expenses and getting revenue from the TBTA to offset the loss of the revenue from the passengers. But if we lose, the real estate market doesn't continue the way it's going,
Be terrible.
we're going to lose that funding. And we might have lower
Michelle,
ridership too.
What does the city pay for the mobility tax? About 78 or 80 million?
I'm sorry, I don't have those numbers
No,
offhand.
I think that's it. I've looked at it, and some other jurisdictions who are paying complain. When I
Mr.
was,
Chairman, if possibly OMB might have that information?
No,
Sadly, I don't have that information off the top of my head either.
It's in your annual report. I
Thanks for
remember
thinking
looking
I
at
might.
it. But what I was going to say, when I was on the board, and I'm still on the board of HHC, Marlene cursed me because I was at the TA when that thing passed. I said, what do you want? I says, the TA pays it. The MTA pays it. Everybody pays it. It's a tax on the payroll. And if you didn't have it, you wouldn't have a system. You have to. You have to have your tax-supported subsidies.
Yep, absolutely.
And, I don't know.
We actually have a rough estimate. For 2015, it was about $50 million.
For the city?
Yes, total collection. It's not including CUNY, but yes.
Okay. It's a big number. It's a fairly big number. The thing is, I was just a part-timer when I retired from the city at the MTA, and I was working on one of the pension funds, but I remember the chairman saying, that's the definition of public transportation. You have to have subsidies to support the fare. Otherwise, God knows what the fare would be. I guess it'd be about $6 or $7 or something. They used to do that calculation periodically.
I think
It would just be prohibitive. It would just be prohibitive.
The year before it was like $5 to $6.
That's right.
And
it would be.
The other point I wanted to make, just in passing, is when the city, when it had its fiscal crisis, the Financial Control Board had then required that certain component units report on a financial plan, and one of them was the TA. Well, the TA was not a component unit of the city. However, they were wise. They said, if you don't have a viable transportation system, how will people get to work? So it became, and it's still, that's why you're here, not because you're a component unit. Notwithstanding that, the controller can audit any unit, be they component, be they not, if you're getting city funds, and that's my piece.
Well, the city is near and dear to our hearts because we're here. The city is near and dear to our hearts because we're here and we use the same system. So we
keep the trains running, really.
We want, and we want to improve them. So these capital improvements are exciting for us because they mean a real big difference for the future, for what has to happen to keep this thing running.
Are there any other questions?
I have some questions.
Go ahead.
First of all, there's a lot of discussion in the MD&A about the economic situation in New York City.
Mm-hmm.
I just wonder why you feel compelled to do that, but if you do, I can't question
what
it.
Page are you on?
No, it's on pages 12 and that sort of thing. So I'm
So, Mark, if I could actually, I'll just answer that really quickly. That's actually a requirement in the MD&A. You have to speak to the overarching economy that affects your organization in the MD&A.
I withdraw the comment.
Yeah.
That was quick.
I think it puts a perspective a little bit on what's going on in the financials.
Okay, then let me ask you something. On page 15, you refer to modernization of 6 interlockings. What is an interlocking?
The interlocking is the way the switches occur for the trains to move from say the yard back out to the maintenance way of the track. So what happens is there's a lot of automating those interlockings, you can more effectively handle
I got my answer. It's not a financial term. The other thing,
a lot of this is going to be run by computers now, so you'll see a lot of the interlocking will be controlled by the computer, saying they'll hold the train here and then the one goes through.
Then also on page 15, you refer to, in the next to last paragraph, return on pensions. It's not a return on pensions. It's a return on the assets.
Where is that, Mark?
What page again?
Page 15.
Yep.
Is it the translators or?
You say the authority plan includes certain risks such as possible lower investment returns on pensions. The pensions don't have a return. It's the assets in the
It's pension assets.
Yes.
Oh, that's a good point. That's a good point. We'll make that change.
Oh, boy,
Okay.
score one for the home team. Now, this is a technical question. On the unredeemed fare cards, do you have an escheat problem here?
No, as far as sending them up to New York State for
Yeah.
No, we are technically New York State, the transit
therefore
authority,
it's
so we really don't have to transmit it to
Okay,
the state.
that's the
So,
answer.
yes, exactly. Yep.
That's the answer.
There was an increase in that, and that's mostly due to the change of our discounts that we
Okay.
did with the fare increase, so that caused that to jump
Then
up.
go on, please, to page 28. You say calculation and requirements of a shadow price. What is that concept? I'm just not familiar with it.
Which paragraph is that
It's the
one?
last paragraph, and it's after it's the last part, the beginning of 3. Calculation and requirements of a shadow price. I'm not familiar with that. Can you tell me what that is?
Yeah, this is.
Yeah, 28.
You know, Mike? I thought that was a character out of the comic books. What does a shadow
Oh, there it
price
is.
mean there?
I see it.
You found it?
Price. Yep, we got it.
Yeah, I got it.
Okay,
Yeah,
well, can you tell me what it is?
So the shadow price is, these are pooled investments. So I think what this is getting at is, if you looked at the price of the underlying investments that are within the pool, and then compared it to the pool's fair value overall, that's what I think this is getting at.
I've never seen that phrase before.
This is common language from the pronouncement.
Okay.
Yeah.
Yeah, this is Gatsby 79.
On page 36 in the cash, you say commercially insured funds on hand and in transit. Is that who insures your funds in transit?
So we have, this is risk management. We have policies, like insurance policies.
This
Oh, no,
sounds
that's-
like it.
No, sorry. No,
I'm
no,
just
no.
trying to understand what the risk is that you're insuring against.
No,
And
no,
who-
this is
Personal
part of this is
injuries.
what's in the money room.
No, it's
Yeah,
not.
This is part of what's in
They
our
always have.
master money room.
So the toll
The
collection.
toll collection, I mean, not the toll, the fare collection.
Oh, this is ensuring that the cash isn't stolen. Is that it? Oh, all
Yes,
right.
yes, yes.
I forgot about that.
When you buy from Kawasaki, do they set up a plant in upstate New York to assemble? Because Bombardier used to do that.
Yeah, there is a plant for the Kawasaki in New York State. The
Yeah,
real
they
question
want-
is,
all right,
what
all
part of
right.
the contract are they
Okay.
doing, you know?
That's a smart thing to do.
Heck, we have the taxis in New York are not made domestically either.
No, that's smart.
That
That's-
infuriates me. Let's
Probably
go,
is.
Pete, to page 48, and I'll get rid of my comments. In the MAPSTOA, there's a wage increase of 3.5%, and yet NYSER assumes a wage increase of 3%. What is the difference between who?
I think those are, Mark, excuse me, I think those are just assumptions, right?
Well, I understand, but why do you have different assumptions?
Because of different population too.
Well,
Is it?
Mapstoa has a lot of managers, like,
Oh.
and NYSERS, it's more the operation.
Right.
Right.
So it's
It's
a
a different pool
different pool of
of employees.
Okay. I understand that now. Two more and then I quit. I did not obviously read this against the city stuff, but I assume that the disclosures under other post-employment benefits and
They
all
would
this
be the
stuff
same.
is going to be the same as the city?
Sure.
Similar. It's
Yeah.
similar. It's just
I would think so.
different plans.
And then the assumed rate of return on trust assets is 6.5%. I thought we were down to 7. I thought we were at 7.
What
elsewhere.
page?
Page 54. Didn't we see something about assumed rate of return on assets at 7 now?
Yeah, there's 7.
Well, this says 6.5 here.
No, but this is OPEB, not NYSERS. This is
No, I understand.
right.
I understand, but there are no assets. So what difference does it make? Is that it?
The percent doesn't matter. They're not funding
Well,
it.
this
That's a
is
good
the,
point.
I-
Okay.
I believe it's the actuarial calculation.
Yes, the actual
So that's the discount rate used in the actuarial calculation of
Why is
liabilities.
1.7 and 1.6.5?
They have their own
That's not a
actuaries.
discount rate.
They don't
different
use the city's
No,
actuaries.
Yes.
They hire a third-party actuary to do the calculation, Mark, therefore there's a disconnect. And it's based upon the rates and assumptions that go into that particular calculation. So that's the actual number that was
So
used
would
by
I
Milliman.
assume that if they hired the same actuary, it would come out the same way as the city?
Not
Or is it
necessarily.
different population?
No, not necessarily. It's based upon demographics.
It's the demographics of who's covered.
Bit different, huh? Okay. All right, Bernie, I'll shut up for a while.
Yeah, it's
Oh, one more question, just because I ride the subway. 63. What's a green fee surcharge?
Oh, so this started, I want to say 2 years ago. You have to pay $1.
Oh, to get a new
for-
card?
To get a new card.
Yeah,
That's what
it's a
the
new
green
card,
fee.
Oh, not a golf term, huh?
But you notice people got smarter. It's a little less this year because they know how to refill their cards more.
I know what that is.
Well, that's what you want, right? You don't
Right.
want
We want to save it. Right. It's expensive to buy those cards and
Mr. Khan, did you
and
have any
save the
further
environment
questions
by
while
not-
he's looking?
I'm done.
Yeah, he's done.
Thank you, Mr. Chairman. With regards to your, on 63, you have your rental income. I mean, given the economic environment, if things don't hold, I mean, what's the total total amount of assets that you have in your real estate portfolio? What's the value?
Real estate,
off the, off the top of our head, I don't have that broken
I don't.
out.
I wouldn't.
We have to get
There's
back
a
to you.
different department that it's, but we can get back to you. It's an MTA department. It's not. We don't have like our own, so we can reach out. They hold all MTA agents
All agencies.
together. Yes, it's not. Yeah, but we can find that out for you.
In certain large stations, there are concessions.
So certainly, like for example, we have now a turnstile at Columbus Circle where you have, I mean, it took over a decade, but we finally have shops down there. You know, I mean, I assume there's other real estate holdings beyond that.
Fulton too, like the Fulton, right? here, Fulton
Right.
Street.
Fulton was a big addition.
That was a
yeah.
big addition.
Is that rental income or station income?
I'm sorry.
You have another line, station income. Station income.
Well, there's the income that's generated in the station itself, like inside, like when you see like the concessions for like magazines, like within the station, and then you have the like Fulton Street, I guess. it's like
Shops.
the shops. It's
The
different.
retail.
The retail, yeah, the retail.
I got it.
Okay. If you could just use your microphone. There's webcasting, so just as
okay.
Sorry.
people, when they want to view this online, would have an easier time hearing. Well, I mean, it'd be appreciated just to get a sense of what, you know, the real estate holdings are, because the income from that also obviously supplements your operations and your costs. Is there a plan to enhance other spaces that are under your control that could also be used for businesses to operate from?
Yeah. Yes. When we're completing each of the new projects, like the Second Avenue subway, we're also going to be able to rent more space out to vendors and make some income from all of those. So every time we look at a new project now, there's a concept of making sure that it has the ability to have levels where we can put in shops that we can rent out and utilize the space effectively as best we can to generate as much revenue as we can.
That's great.
And from what I understand, the vendors are very happy wherever we do have a location where vendors come in. They find that these locations are very successful. They have a good return from the traffic that goes through.
No, I think that's true. Though I do think at Turnstile, just having gone there many times, you have like 7 coffee shops. So I don't know if there's too many, but stiff competition.
Yeah. I think that's the revenue. You can see the volume of traffic. It sort of creates that demand. You know.
Or long-term success. The other question I have is a bit more specific. On page 49, it's with regards to MUBSTOA's holdings and the different asset classes. It seems like your alternative component is a bit high. I mean, just in my observation. I mean, are you who makes is that the board of MUBSTOA that makes those determinations?
And there is a chief investment officer too, specifically MUBSTOA, and I don't know all the details, but I don't know if at some point, am I correct? It was even a little bit higher.
Yeah, so this amount, you're correct, Jackie, was higher. A significant portion of this is investments in pooled investments, so pooled account type investments, which have underlying investments in many different categories, but because of the nature of this investment, it falls within this alternative bucket.
Alternatives.
Yeah.
Okay.
So, within there are some fixed income, some U.S. public equities, things like that. So,
wait, within alternatives?
Within these pooled investments that they have, right? So their investment is a pooled account investment.
No, I understand.
The underlying have investments in fixed income, public equities, things like that.
Okay. So it's just a way it's categorized. Because, I mean, for example, the public equity is on NICERS. We're divesting from hedge funds, for example. And, so I just wanted to, as with regards to cost. And what are the total assets under management for MUBSTOA?
For the MUBSTOA plan is $2.3 billion.
Okay.
Yes.
Okay.
Thank you. Do you have any more questions of the people from the Transit Authority? If not, thank you.
Well, we need to go to Sertoa.
Do we go to Sertoa?
I'm sorry.
Would you like me to go
Staten
to
Island.
Sertoa? Staten Island?
Oh, you'll do Sertoa?
Yeah.
Now we'll switch over to Sertoa.
The most subsidized system around.
Correct. I'll do it quickly. So if we turn to page 14, I'll start with the statement of revenue and expenses. Total revenue in 2015 increased about $729,000 or 9%. This increase was mainly due to fare revenue increase. We had the March 2015 fare increase affected. That was like $500,000. And there was also an increase in ridership of 3%, plus also other revenues increased by $165,000 for advertising revenue. Total operating expenses, we had an increase of about $5 million, or 8%. The increase was primarily due to the following items. We had salaries and wages increase of about $1,965,000. This was due to an increase in retroactive wage accrual for the UTU settlement, the United Transportation Union, and also wage increases in 2015 for non-represented personnel. There was a decrease in pensions for about $1,379,000. This was a result of the adoption of FASB 68, which is in line with TA also. Other post-employment benefits actually increased for approximately $5,434,000. This was based on the latest actuarial evaluation, which was reflecting adoption of benefits for represented members similar to those of New York City Transit. There was also a decrease in the discount rate from 3.75 to 3.5, and dental and vision benefits are now provided by Sertoa to retired represented members until they're eligible for Medicare. Other fringe benefits decreased significantly by about 2.4 million, and this was due to a lower workers' compensation reserve requirements per the 2015 valuation report. And there was an increase in environmental remediation for about $1,161,000, and this was due to new environmental projects that started in 2015 in connection with the St. George interlocking capital project related to asbestos removal. Moving to the non-operating revenues, there was a total increase of $15,711,000, or 48%. This was mainly due to an increase in the estimated 2015 New York City operating recovery subsidy.
Could I stop you there?
Sure.
Does New York City give you this money?
Yes.
The operating, because for a while they stopped supporting.
Correct. Yes. They started back, I want to say, I believe it was for the year 2012. That, right, 2012 they started, and it's in a 1-year lag. So, for example, the 2015 amount that's recorded is based on a projection. And then around August, then we, like, for example, the 15 is going to get finalized this August for the actual, and then there'll be a projection for the 16. So it's in a year lag.
And it actually is a cash payment to the
Yes.
Sotelo?
Yes. They send it directly to the MTA, and then so the MTA receives it on behalf of Serto, and then they transfer to us. And then capital contributions.
You know what the issue was, why the city stopped it? Because people were able to ride free. If they didn't get on St. George and didn't get on, I think, at the other end of the island, there were no conductors, there were no machines. They could just get on the train, ride free, and then get off, and that was an objection. Okay. Have you built any, has Satoa built, turnstiles?
Go ahead, we're going to defer this to.
I could answer to this. In 2014, we did a study. I was the assistant chief at the time, and Mr. Montgomery, if you remember.
Please speak into the mic. I'm sorry, sir.
Oh, that's okay. If you remember, Mr. Montgomery was the VP and the chief. We brought in the Fare Collection Division, the Operations Division, and we looked at the fare collection numbers and the ridership numbers, and we examined the whole infrastructure of Staten Island Rail. And at the time, with the new fare collection initiatives, it was deemed that it was not cost effective at the other stations because of the design, the electrical, the concrete work, and all the things that had to go in to put the MVMs or the collection device in place to maintain it and to enforce fare collection. We would be a losing proposition over 20 or 30 years. We still wouldn't recoup the original investment, and the maintenance would be a loss year by year. Because 85% of the ridership does go to St. George, and we are collecting the fares.
Yeah, there you have
so, and that's basically where it was at. We're going to look at it again with the new fare collection systems that we're looking at buying. We did look at tickets, we did look at apps, but none of them were cost effective.
Let them ride for nothing. No, that's all right, because it doesn't pay to put it in.
It doesn't pay to put it in.
Well, we had turnstiles at the other station, the next station.
Tompkinsville. Tompkinsville were installed.
You have it there.
So we have it both.
Yeah, you have it at the two terminals.
And then we also have the detectives, the Eagle squad, which watches to collect fare beaters, and that's one way to enforce it, to try to get people to comply. But of course, it's still not a perfect way to do it.
Do you have a number of the loss per passenger on Staten Island as compared to the loss per passenger in the rest of the city? How big a subsidy is the rest of us providing to Staten Island?
That's an interesting question, because you could see from the loss, from the fact that the fares are not covering the operating costs, what the loss would be. We didn't do it per person, but the real issue is it's really part of a system. So if somebody's taking the train from their original station to St. George's, getting on a ferry, and then coming over to use the main system, they're really paying for the use of the whole system. So it's a little hard to quantify just the one piece of the system to say that it's going to pay for itself.
I didn't ask how much it paid. I just want to know I, as a subway rider, getting a subsidy in Manhattan. Definitely.
Yes.
But it's a much less subsidy than somebody coming from Staten Island.
Not many people use it. Oh,
That's
they
true.
use the express buses.
It's true. They also use the buses, which is but you're right. It doesn't. It's on an economic basis. You would think that group should pay more for that trip.
Yes.
But it would be. It's really not. Not going to be something that you would be able to do. I don't think with the way the system is structured. So I mean, it would have to be like a Long Island Railroad operation, a zone, sort of a zone system, which would be a completely new dynamic for the way we handle the fare collections. So,
or we tax Staten Island.
I mean, it's
I give up.
The other thing is Staten Island, of course, has a lot of work went into it. It took a major hit from Sandy, and we, of course, and we had to do a lot of repair work in the last year.
B&O got rid of it years ago.
Because the capital expenditure to
correct, yes.
to keep it up to keep it running is pretty high, you know. So basically, the entire yard and tower and interlocking and had to be replaced, as well as a lot of the track has been replaced too. So it's an expensive proposition.
It's also politically not expedient.
If I could ask, how do you do the estimate of ridership in from station to station when there's no turnstile present?
Well, we capture when they're at the end of when they come out of the system, they have to pay on the way out. So
right, but you had said earlier that 85% of the riders actually go to St. George. So how do you know the other 15% does not? If you're not essentially counting from a prior station to the station thereafter where there's no turnstile.
Well, they do an overall survey. It's done, I think, every 4 years. And also, if we do capital needs, we also do assessments. So we'll do spot checks to check the ridership, who's getting on, where they're getting off, what the people counts are. So for physical counters out there.
I see. Have you ever hired an outside firm, for example, to actually do a firm count for an estimate of the ridership between all of the stops prior to Tompkinsville?
Truthfully, I can't speak for the whole history. I know that we counted 4 years ago, whether it was a private firm or in-house. We do have a consultant firm that's presently there doing it because of the rezoning of the Bay Street corridor structure. So they're looking at the environmental impact, and they're doing a head count to see if our numbers are correct. It's not a primo full count, but they're doing it at specific stations for the rezoning, and then we'll compare their numbers to what we had, and we'll make assessments accordingly.
Okay, thank you.
If there are no other questions, thank you all.
Keep them running. Bernie, quick. Let's go. Don't we have it?
The third conference. That's the question. Well, we have
Warren is here.
He had to be here.
I'm going to be in trouble. I've got a client worth $700 million.
Sure.
Lunch for today. 1:30. 42nd Street and 2nd Avenue, Japanese restaurants. Okay, Mr. Chairman, let's go.
Okay. You want to quickly introduce yourself so I know you?
Yes. Joan Barrow, Chief Accountant, Deferred Compensation Plan.
Beth Kushner, the Deputy Director of Administration for the Deferred Compensation Plan.
Warren Ruppel, the Engagement Partner for Marks Paneth.
Ed Chen, Manager, Marks Paneth.
I think you're doing very well, right?
Yes.
With all the, just very quickly, with all the options that you're offering, Ron, do you feel you have too many balls in the air, or are you planning to offer more?
I think we've settled where we are.
You kind of settled?
We have.
I think you have enough. I mean.
We have the 457, the grandfathered 401k, and the IRA, and a 401a for some employees, and then we added the Roth component as well as the traditional. So as the IRS allows new plans and new types of programs, we are eager to implement them and give our employees the most choice.
And the small increase in net assets in 2015, 457, was because of the appreciation of
Yeah.
the portfolio.
That is, yes, that's correct.
All right. There'll be better years, I guess.
You hope.
What is your total under investment? About 13 billion?
I'm sorry?
What is the total before 57 plan?
Before?
Yes, 13 billion.
Yes.
13. You're bigger than some of the pension funds in the city. Yeah, no, really, they have grown.
A quick comment.
Yeah.
Many of the places you talk about interest, but you don't talk about dividends. I presume your income is interest and dividends, and yet you keep referring to interest earned on assets. You don't refer to dividends.
Yeah, no, that would include it's total investment return, so it would include
It
dividends.
would include dividends. You ought to look at whether saying that way. Warren, I got some little junk here, but I tell you, somebody who used to run a money firm had 11,000 different options. Seems to me an administrative chore that maybe you want to think about. I bet some of those things are very small. But that's a business issue, not a...
Thank you, sir.
So just point out, we did kind of combine some of the GASB 72 fair value information this year. It was something that was suggested at the committee last year, so we're able to do that and make it fewer pages, but still a lot.
Oh, the environmental people will love you, Warren.
On the 457 plan, the equity index fund is almost as big as the stable income fund.
Yes. Yes.
So the people are playing a little bit with the market.
Sometimes.
So let's say they want to change. In other words, they were 100% the stable income fund, and they want to go to 50-50. How long do they have to change?
How long? They can make any changes up until 4 p.m. Eastern time, and they'll get that day's...
Almost immediately?
Mm-hmm. They'll get that day's market close.
I'm sorry?
They will receive that day's NAV, the market close.
I don't know.
They can make any investment changes up until 4 o'clock Eastern time, and they will receive that day's market price.
You move that quickly for them.
Yeah, we're daily valued, unlike
Yeah.
the pensions that may be monthly
With-
valued.
With the computer, Bernie, you can do it like
No,
that.
no, there was a time.
There was a time, yes, it used to take several days or weeks.
And there was a time you wanted to give them some time. Maybe they changed their mind, maybe they could do it gradually, but they could do it immediately.
Correct.
But there's a waiting period to go backwards.
Speak up, Ma.
I think there's a waiting period to go backwards.
We have, there's a 32-day, for those people who are making transfers in and out of the funds. There is
You gotta speak it.
I'm sorry, there is a redemption period, a 32-day redemption period for those people who are playing the market. Because that impacts the fund as a whole, so there is that.
It's not unusual. Okay, anything else?
Okay. I think we're all right. Warren, what was your management comments?
We didn't have any management letter comments.
Just
We had
Just,
an
we
IT, just an IT letter.
On the financial statement side, there were no comments, so we had a no material weakness letter. We do, there were a couple of technology recommendations that were not deemed to be.
It's okay now, the confidentiality of the data and so on.
Yes. We had no IT comments for this year. The open ones were the prior year.
Okay, and they were adjusted.
Mr. Chairman, I have a question.
Yes.
What is the selection process as far as identifying your fund managers for the different funds? So if you could just...
Sure. We follow the state procurement rules, and we work with consultants, and we have a board. The board works with the consultants after going through a consultant-driven procurement process. They will select the managers, and that is a board decision along with the consultant's recommendations.
So there's an RFP that's issued, and how often is that evaluated? So, for example, I'm looking at the Global Socially Responsible Fund had a negative return of 13.5%.
I knew you were going to ask that. Yes, the performance is brought to the board on a quarterly basis, and the consultants will make a recommendation when the time is up for a renewal. Whether or not they recommend it, the board will then make a determination. Since that time, that manager has been swapped out, and in March of this year, it has moved to an index fund with a new manager.
Okay. And I just, as a personal note, I have attended a couple of classes down on Rector Street.
The seminars?
Yeah, seminars, and they're very educational. I would encourage as many city employees who are eligible to attend these and help secure
All city employees are eligible.
Right. And so that's helpful to know, by the way, just that it's a quarterly evaluation, and that manager has been swapped out.
Yes.
Oh, and the next question was with regards to your custodial fees for your 457. It went from 907 to 945. Could you?
The fees are transaction based, so if the participants are making a lot of transactions, the fee will tend to go up and down.
Let's go.
If there are no, are there any more comments? If not, I thank you for your patience.
Wait, I just have one very minor comment. There are a couple of charts here that look like they might be able to be done larger if they were done landscape. I don't know if that's true or not, but you might want to consider it.
Sure.
Thank you.
It's a foolishness.
What page?
The investment options section?
Yeah, I happen to be on page 28, but there were several that looked like they might be able to. It's really not a particularly important comment.
Readability.
There's some more stuff in here, and I'll leave you with some stuff.
Okay.
Part of it is because I used to do this thing.
Thank you.
Oh, thank you all again.
I'm not sure.
Actually,
could you give regards to Georgette?
If I could ask a quick question, just
Yes.
a quick question. So I know that you had said earlier that that participants have the ability to play the market in the fund. I think my opinion of that would be a little bit different in that the ability to move it out of essentially the targeted funds to play the market is still forcing participants into specified mutual funds that are designated by the DCP itself.
We don't have any mutual funds. We're all separate accounts.
So has there been any discussion recently about the ability for participants to truly have the ability to invest in stocks, for example?
No.
Will there be?
That's a board decision. We have the self-directed brokerage option that participants can elect to go out into and have a broader, actually they're all mutual funds.
Yes.
That they can
That's
go out
what I was
into
referring to.
Yes.
Mhm.
The board has not made a decision to offer individual stocks at this time.
That's unfortunate. Okay.
All right, thank you again. Would you give my best to Georgette, please?
We will. Thank you
Tell
very
her I
much.
sent it. I would appreciate it.
Thank you.
Okay, very good job. Oh, yeah, I'll make a mention of it. Do it now, you think?
Yes.
Yeah.
Then we're going to take a motion to go in executive
Yeah, before you people leave, I just want to thank you. I gather this is the last meeting you'll be attending as related to the city's I'm not talking about your other clients, but I want to thank you for all your services, professionalism. It really was wonderful. And I know you a long time, and it was a very nice relationship, and I wish you all the very, very best. Thank you again.
Motion to go into executive session.
Yeah, I made the motion already.
We had to do it again because.
Oh, okay. We need a motion to go into executive.
I move it. Let's go quick.
Yeah. I just
second
want
that.
to take a break for a minute, please. Yeah, just,
I got lunch with a woman who's worth $800 million, for God's sakes.
well, that's no money.
Okay. Second.
All in favor, aye.
Aye. Thank you.
Thank you.